Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500, and more specifically, I want to talk about leverage in this video. I'm going to show you a couple of charts that are hopefully going to make you understand the current situation a little bit better. We're going to talk about what impact this has on the economy, what impact it can have on the stock market. Now, without further ado, let's get right into it. Now, the first thing that I want to show you on this chart, this monthly chart, is the MACD, right? This is a momentum indicator that a lot of investors pay attention to. It gives you that broader, longer-term momentum. Right? For example, right, when you have this bearish crossover on momentum, you have this bear market that plays out in 2000 to 2003. The same thing goes for 2007. When you have that crossover, it leads to that bear market. The same thing happens here in 2015. You have a crossover, it leads to a period of consolidation in the market. And again in 2018, right here, crossover, period of consolidation in the market, right? So can we expect a very similar type of development now that we have this crossover on the S&P 500? And the first thing I want to show you regarding that is the whipsaw signals that we've had in this period. For example, let's actually go back to 1994. Right here, you've got a first type of whipsaw signal here where you have a bearish cross on the monthly chart right here. And you can see just after that monthly crossover on the MACD, when that blue line begins to separate down from the orange line, that's pretty much the market bottom. And you had pretty much the same thing right here in 1990. You had bearish crossover, although you could argue you had a bearish crossover here. In that case, it's not a whipsaw. But here, as soon as these lines begin to separate, you have a market bottom. Same thing again in 1987. Those lines separate and you have a market bottom. That's just to show you that the monthly crossover on the MACD has not always been 100% accurate. It's actually led to some pretty big whipsaw signals where investors would have missed big market bottoms if they had stayed out of the market. The same thing applies to 1998 here. Crossover, blue line separates from the orange line, and that's a bottom. And I've got one more example here, and this is controversial, but I'm going to show you in just a second why I believe these 2 points are very important. You've got a crossover here in 1999, and you could argue that this is a market bottom, right? From the bottom here to the top of the market, you had a 25% run before the market topped. Now, yes, the market then proceeded to decline 50%, right? So that just gives you an idea of where we could potentially be now. Right? These monthly crossovers, they don't determine what's going to happen now, right? They give you an idea of that longer term trend. That doesn't mean that the market can't make another run up or that it can't be a whipsaw signal and we have the bull run resume. Now, I think we're more likely to be in this type of scenario, and I'm going to show you why in just a second. Here in 2006, you had what looked like a crossover, right? You had the blue line just under the orange line. You can't really see it here, but it was almost a crossover, and that marked again the bottom and the beginning of the final bull run to a bull market top. So similar to 1999. Let's zoom in here. In 2011, it was also a whipsaw signal here. Crossover, market bottom. Let's fast forward to 2018, right? I'm just going through all of these points just to give you guys an idea of what type of market environments, what type of scenarios can play out following a monthly crossover. If we take a look at the 2018 example, as soon as you have these lines separate here in the month of December 2018, that happens to be the very same month that marks the bottom of the stock market. And that eventually leads, very similar to 2007 and 1999, it leads us to a bull market top. So we've taken a look at a bunch of different examples here of whipsaw signals, times where it actually played out for bear markets or periods of consolidations, but many whipsaw signals that led to bull runs or that led to big rallies into bull market tops. So where do we think we are right now? Let's put up the yield curve, so the 10-year minus the 2-year here, and that's going to give us an idea of where we are in the business cycle. We've been talking about this for months, and I sound like a broken record, but I think this is incredibly important information to understand. When you have a yield curve inversion, the market doesn't top straight away. It tends to perform well in the months ahead. And so we have to take a look at those 3 examples where we had yield curve inversions. And so that puts us in the 1999 example, the 2006 to 2007 example, and the 2018 case study. And so in each of these cases, downside risk is elevated. You almost had a 40% drop off the all-time high. Here it was a 50% drop. Here it was a 60% drop. But before that, you had exceptional price appreciation throughout the 6 months that followed that crossover. Now, this is not just blind observations about the market, right? We actually have an underlying thesis on that. And I'm going to go through that very quickly. The entire argument behind this SP 500 volatility is that the Fed is beginning its hiking cycle. That is what has triggered this volatility. And in fact, the market is right. The Fed is very likely in May to do a 50 basis point hike, right? That's very probable unless we get some big shifts in inflationary readings or we get rapidly rising unemployment rate until then, which is not very likely. We will get a 50 basis point hike. But that's been priced into the market. Think about how the market works. When everyone is very well aware of something that's going to happen, like a 50 basis point hike, it's baked into the market. Now, I know I'm going to get comments saying, yes, but a 50 basis point hike actually has a negative impact on the economy. And they would be absolutely correct, but not straight away. A 50 basis point hike will have a big impact on the economy a year later. I don't think the market can endure a 50 basis point hike. I don't think we can get to 1% Fed funds rate without triggering a collapse of the economic boom that we've had. But that won't come until a year later. For now, all that really matters. And I know this is frustrating because it's very strange how all of this works. But for now, all that we have to worry about is what has already been priced into the market. And if we take a look at the investor sentiment, so the number of bulls minus the number of bears in the market, we're still in incredibly bearish territory, right? Typically a territory that marks major market lows because everyone has already sold based on the information that they have. Selling now because of tightening is like